For years, Europe relied heavily on Russia to supply natural gas for electricity and heating. Before 2022, approximately 40% of the natural gas used by the European Union came directly from Russia. Certain countries, like Germany, were even more dependent, sourcing about 55% of their gas from Russian pipelines. This reliance was based on a simple premise. Russia provided ample gas at competitive prices, making it a practical and stable solution for Europe. However, this dynamic shifted drastically in 2022, when Russia launched a full-scale invasion of Ukraine. The war sent shockwaves across Europe, prompting leaders to reassess their energy policies. Supporting Ukraine meant severing ties with Russia, and the European Union wasted no time. A series of sanctions were implemented, and the EU set an ambitious goal of eliminating Russian fossil fuels entirely by 2027. This decision forced Europe to find alternative energy sources quickly to avoid an energy crisis. One of the first solutions was turning to the United States. Liquefied natural gas, LNG, exports from the US to Europe surged, providing a lifeline as Europe sought to diversify its energy supply. By 2023, more than half of America's LNG exports were headed to Europe, helping the continent navigate its energy challenges. This shift was made possible by increased US LNG production and Europe's urgent need to reduce its dependence on Russia. However, this new reliance on the US came with its own risks. American politics, particularly under Donald Trump's presidency, had demonstrated volatility. Trump's America First policies disrupted global trade, introducing tariffs on imports, including European goods, and raising concerns about the future cost and reliability of U.S. energy exports. This uncertainty led European leaders to seek alternative long-term energy partners. One promising option was Canada. The EU and Canada already shared a strong trade relationship, bolstered by the Comprehensive Economic and Trade Agreement, CETA, signed in 2017, which had increased trade between them by 60%. Canada, with its vast reserves of oil and natural gas, was well positioned to become a stable and reliable energy partner for Europe. Canada had its reasons to diversify its energy markets as well. Historically, it relied heavily on the United States as its primary trading partner, with about 80% of its exports heading south. In 2023, Canada exported $143 billion worth of crude oil to the U.S., accounting for 90% of its total crude sales. However, tensions during Trump's presidency, such as the threat of a 25% tariff on Canadian goods and a 10% tax on oil exports, pushed Canada to rethink its dependence on the U.S. Canada's government began actively pursuing a strategy to reduce reliance on the U.S. market by diversifying its trade relationships. This plan, initiated in 2018, aimed to increase non-U.S. exports by 50% by 2025. Canada has made significant progress, striking trade deals with countries like Indonesia and Ecuador while targeting energy-hungry Asian markets, particularly China and Japan. The expansion of the Trans Mountain Pipeline has been a crucial part of this strategy. This project provided Canada with a faster route to export oil to Asia via the Pacific coast. By late 2024, China was importing an average of 150,000 barrels of Canadian heavy sour crude daily, with some months reaching 240,000 barrels. China's growing interest in diversifying its energy sources, coupled with shorter shipping times from Canada, made Canadian oil an attractive option. Similarly, Japan's demand for LNG is expected to rise by 10% by 2040, and Canadian officials have prioritized discussions with Japanese leaders to secure future LNG deals. One ambitious LNG project that captured attention was the Energy Saguenay initiative in Quebec. Initially proposed in 2014, the $7.2 billion plan aimed to build a massive LNG facility powered by hydroelectric energy, reducing its carbon footprint. The project also included a 782-kilometer pipeline to ensure a steady supply of natural gas for export. However, environmental concerns, such as increased carbon emissions, risks to the beluga whale population, and negative impacts on indigenous communities, led to its cancellation in 2022. Despite its setbacks, the potential revival of the Energy Séguné project has been discussed as global trade tensions and energy demands grow. Quebec's government has indicated that any future attempts would require public approval and stronger environmental safeguards. However, challenges remain, particularly regarding the beluga whale population in the St. Lawrence estuary, which faces threats from increased shipping activity. Additionally, the project's estimated annual emissions of 50 million tons of CO2 would conflict with Canada's climate goals and international commitments under the Paris Agreement. Canada's efforts to diversify its energy markets extend beyond Europe. The LNG Canada project in British Columbia, set to begin exports by mid-2025, is another significant step. Once operational, it will export 1.8 billion cubic feet of natural gas daily, with the potential to double capacity in its second phase. This project positions Canada as a key LNG supplier to Asia, reducing dependence on the US and tapping into markets eager for stable energy sources. This shift has implications for US energy markets as well. If Canada redirects its natural gas exports away from the US, it could create supply shortages and drive up prices, particularly during periods of high demand. American refineries that rely on Canadian oil may face higher costs, which could ultimately affect consumers. At the same time, Canada's expanding energy trade with Asia and Europe strengthens its economy and reduces vulnerability to US trade policies. The broader geopolitical context further complicates North American trade dynamics. Trade disputes between Canada and the US have strained the United States-Mexico-Canada Agreement, USMCA. Tariffs and retaliatory measures disrupt industries like automotive manufacturing, where components cross borders multiple times before reaching the final product. Rising costs from these disputes could affect consumers and weaken investor confidence. Meanwhile, China has been leveraging these tensions to strengthen its global trade position. By restricting exports of critical minerals like gallium and germanium to the US, China has targeted industries essential to technology and defense. The longer North America's trade disputes persist, the more opportunities China has to fill the gaps left by fractured supply chains. In light of these challenges, Canada's efforts to diversify its trade relationships and energy markets are not just economically prudent but strategically necessary. The country's growing presence in global energy markets positions it as a reliable partner for Europe and Asia, while reducing dependence on the unpredictable dynamics of US trade policies.